All right, hi everybody. Today we are going to talk about Google's Q4 results, Google's 2024 fiscal results, the reaction of the broader market. As of right now, Google stock is down more than 7%. We'll talk about the business performance in the cloud segment, in the search segment, the impact of DeepSeek, and much more. So without further ado, let's get started. All right, as you can see, I have prepared another board that is going to walk us through this video to add a little bit of structure to it. And as I said in the introduction already, just to look at the stock performance, as you can see here in after hours trading, after Google reported their results late Tuesday night, that's Central European time, the stock was already down around 7%. And when the stock opened today, we see basically a similar performance. So the stock of Google is down to, I'm not even sure, I guess something similar in US dollars, down below the $200 a share mark, down around 7%. And now you might wonder, well, why is that? What did the market not like about Google's earnings results? So let's just have a look at their overall results. So as you can see here, they reported their Q4 results and their fiscal year results. And I have included a few highlights here. So first of all, if we just look at the development of revenue, for example, Google's revenue on a quarterly basis was up 12% compared to last year. And on an annual basis, so the last 4 quarters, the revenue is actually up around 14%, which isn't too bad, I think. The operating margin is also up compared to last year. It's up to 32%. And if we look at the net income here, around 100 billion in net income, that's also up, I don't know, let's do some ballpark math here, almost 30% on a year-over-year basis. So I would argue those are decent results. There's not a lot to dislike here. Google continues growing, continues to expand its margins. So why is the reaction to the results the way it is, Google being down 7%? Well, I think, and now we have to start speculating, I think what investors really disliked here was the guide in terms of CapEx going into the next fiscal year. Because Google guided for 75 billion in capital expenditures in 2025, which was way above what analysts expected. I think analysts expected something like 58 billion, if I remember correctly. And this is significantly exceeding that estimate. And it is a lot of money, 75 billion US dollars. I mean, investors are for the most part worried where that money is going. Is that investment going to earn any return? This is basically what Ross Hendricks expressed in this tweet. So he wrote, Google committing to 75 billion in CapEx next year will be equal to roughly 70% of its operating cash flows. I'll get to that in a second. The Google long thesis has always been owning a monopolized, high margin, toll road on 90% of internet traffic and printing cash. This is the opposite of that. Shares should be down a lot more than 7%. There's no reason to pay 25 times earnings for a business, funneling 70% of cash flow into a CapEx black hole. It wasn't long ago that Meta traded down to 9 times earnings when it went through the same debacle with the metaverse. So I responded to Ross in a separate tweet, in my own tweet, which I'll get to in a moment. But let me just say that I think Ross is onto something. So I think he has a very valid point. I think concerns about the return that is earned on these massive reinvestments, again, 75 billion, I think they are justified. And it really is unclear whether these investments are going to earn a satisfying return or not. And this uncertainty, of course, is something investors dislike, which is why I think the stock is down around 7% as of today. I'm not sure if I like the meta comparison that much. I'm not sure if it's adequate or fitting here, because I think when Meta traded down to 9 times earnings, this was clearly an overreaction. The stock is up something like 6x from the bottom. So I'm not sure if he really has a point here that Google should trade at a similar multiple or a much lower multiple than it is trading at right now. What I also want to highlight here, because here we see the DeepSeek hope, is that I think investors were also anticipating that Google might be guiding for lower capital expenditure requirements, because I guess the hope from the investing community was that DeepSeek has shown that efficiency gains may lead to, well, lower capital expenditure requirements going forward, especially on the application side of things, which Google is actively working on. On the earnings call, they highlighted that they are working on a ton of different applications making use of AI technology and, of course, AI infrastructure. Okay, before we get to the return Google may earn on these reinvestments, I wanted to highlight a few things with regard to Google Cloud, because I think the cloud segment was one of the highlights of the earnings results. What you can see here, let me just open it, is that revenues in the cloud segment increased 30%. This is lower than what was anticipated by analysts, but 30% growth. I mean, what more can you hope for? I think a company growing in a high margin segment, 30%, I don't care whether that's below analyst estimates or not. That's a very pleasing, satisfying rate of growth that is going to create a lot of value going forward if Google can keep growing at this rate. And as they later highlight, I'm going to show you a few snippets from the earnings call, is the demand for cloud capacity has actually been higher than what Google could actually deliver. So the growth rate in cloud might have been even higher if Google had more capacity. So that's, of course, partly what they are going to invest in going into 2025. This chart here nicely illustrates the trajectory of the cloud business. So as you can see on a quarterly basis, we just see a very steady growth of that segment. Basically a CAGR, we see it right here, of around 35% over time, which, as I just said, if a company can pull this off for multiple quarters, that's of course extremely shareholder value accretive. All right, next up, what you can see here is that the operating margin, so the profitability of the cloud segment, is also definitely trending in the right direction. The operating margin of Google Cloud is up from 9.4% to 17.5%, and chances are we will see further margin expansion in the coming quarters. So again, something as a shareholder, full disclaimer, I do own Google shares. It's a relatively small position. Let me just check how large the position is. So as of the time of this recording, it is a 4.85% position in my portfolio, just to be fully transparent here. Then what else do we have? This again is also from the earnings call. It's from the chief financial officer. And he highlighted what I said earlier. Basically, that demand was exceeding the capacity Google had available. Something investors should love to see, because it shows that you can expect further growth in the coming quarters. If we now move on to Google's core business, the search business, well, first and foremost, let's look at the numbers. So on a quarterly basis, Google Search and other, this segment is up, I don't know, I think it's up around 12%. So it's up from 48 billion to 54 billion in 2024. And I guess something investors should also take a look at is where that growth is coming from. As you can see, the mix here basically is that we see a 5% increase in paid clicks overall, and the pricing on a per click basis, well, has also led to 7% growth. And then finally, in terms of search, one other highlight from the earnings call for me was that they highlighted that younger users of Google are starting to pick up Google Gemini as an AI search tool as well. And I guess that is something many investors are and were worried about, that the younger cohort is forming the habit of using ChatGPT instead of Google Gemini or other Google properties. I'm not sure if I'm really buying into this. This is still something I would be strongly concerned about, because the young people I engage with, they use ChatGPT for the most part, but that's just anecdotal evidence. And Google obviously has access to data too. And they also see that their Circle to Search feature, which is basically a feature for Android phones that allows you to, well, use Google search features within other apps by just circling certain items on your phone, like parts of an image, for example. This is a feature that young cohorts are also starting to pick up and particularly enjoy. And as I said, that's just one of the highlights from the search segment for me. So if we now get back to the tweet by Rick Hendricks, let me show it to you again. So he is making the point, and as I said, I think he has a point here, that the return that Google is going to earn on these massive reinvestments is uncertain. And there's also not a whole lot of transparency with regard to where exactly this massive amount of money is going. The question I want to ask here, however, is which Google do you want? So this is basically the rationale or the idea I'm laying out in this long tweet here. Do you want to own a Google that is simply optimizing their margin profile, trying to generate as much cash as possible today, and not doing or placing any strategic bets that might yield an attractive return in the future? Or do you want a more audacious Google where the management team is making more bold investments into the future to make sure that Google remains as dominant as it is today in its core business, just to be clear, I think Google's core business is under threat right now. And hopefully that Google can be similarly dominant in other fields, like cloud, for example. Cloud is a relatively new segment. I think Google started this division, I might be wrong here, but I think they started it in 2006. And now Google and cloud combined are a $110 billion business. And I don't know, Waymo, for example, self-driving cars. This could be a segment that, or it is a segment that Google is investing heavily into, and it could be a future profit segment for them as well. Right now, they are burning billions and billions of dollars investing and developing into this field. Will it pay off? I think it's uncertain, but it could. And I would much rather own a Google that is trying to defend its position and expand its dominant position to other areas compared to one that is just optimizing current profits and thereby neglecting maybe the future position of the business in various areas. So what I also argue here is, I mean, obviously, when you want to value Google, you have to value it on a free cash flow basis. That's something I always recommend. And when you value a company on a free cash flow basis, you also have to take into account stock-based compensation, which is not insignificant at Google. And if you do the math based on the current numbers, so the current fiscal year, well, I basically lay out that you're looking at a 50 times multiple. If you adjust the current free cash flow to capital expenditures over the last 12 months, and again, the CapEx is going to increase from here, and stock-based compensation. However, I also argue that Google right now is not optimized for margins. I think Google could be much more profitable if they really wanted to. However, and just to, I think it's important to always highlight the counter position, as Jessica Ablamsky here highlighted. And I don't know, I think she also has a point here. She wrote, I no longer believe that the CapEx cycle has an end. After AI, it will be quantum or lunar mining, anything to stay ahead of the competition and continue growing at scale. So that is something you have to assess as a shareholder or as someone who's considering investing in Google. Well, is the current margin profile the margin profile you can also expect in the future? Or will Google eventually be able to slow down these reinvestments and then as a result become more profitable, which would make the current multiple look more expensive than it actually is? Okay, then finally, just in terms of DeepSeek again, because I addressed it earlier in the video, there are two snippets from the earnings call that I want to highlight here. So this one is basically just highlighting, if I remember correctly, that Google is very cost conscious here. That's at least what they are arguing, that they are trying to bring the cost of using AI features, Google Gemini, down, and that DeepSeek might have been a milestone of a competitor that might help them bring their efficiencies up as well. And this one here, yeah, I think we covered this earlier, just also highlighted that in AI as well, they have more demand than they can actually supply. Again, something you should cherish as an investor. Okay, that's it with regard to my take on Google's Q4 earnings results. Let me know what you think of the current quarter. Is the sell-off of 7% justified or not? And I'll talk to you in one of my next videos. Take care.